Job order costing, a costing system used in situations where many different products, jobs, or services are produced each period. Absorption costing, a costing method that includes all manufacturing costs, direct materials, direct labor, and both variable and fixed manufacturing overhead in the cost of a product. Allocation base, a measure of activity such as direct labor hours or machine hours that is used to assign costs to cost objects. Predetermined overhead rate, a rate used to charge manufacturing overhead cost to jobs that is established in advance for each period. It is computed as estimated total manufacturing overhead cost divided by estimated total amount of the allocation base. Overhead application is the process of assigning overhead costs to specific jobs using the formula predetermined overhead rate times the amount of allocation base incurred by the job. Normal costing is a system in which overhead costs are applied to a job by multiplying a predetermined overhead rate by the actual amount of the allocation base incurred by the job. A job cost sheet is a form that records the direct materials, direct labor, and manufacturing overhead costs charged to a job. Learning Objective 1 is to understand the flow of costs in the job order costing system and prepare appropriate journal entries to record costs. Learning Objective 2 is to use T accounts to show the flow of costs in a job order costing system. Key definitions regarding the flow of costs. 1. Raw materials include any materials that go into the final product. 2. Work in process consists of units of production that are only partially complete and will require further work before they are ready for sale to customers. 3. Finished goods consist of completed units of product that have not been sold to customers. 4. Cost of goods manufactured include the manufacturing costs associated with the goods that were finished during the period. Raw materials purchases are recorded in the raw materials inventory account. When direct materials are used in production, the costs are transferred to the work in process inventory account. Direct labor costs are added directly to work in process. Manufacturing overhead costs are applied to work in process by multiplying the predetermined overhead rate by the actual quantity of the allocation base consumed by each job. When goods are completed, their costs are transferred from work in process to finished goods as cost of goods manufactured. As goods are sold, their costs are transferred from finished goods inventory to cost of goods sold. Selling and administrative expenses are recorded directly on the income statement in the period incurred. To illustrate the cost flows within a job order costing system, we will record Ruger Corporation's transactions for the month of April. Ruger is a producer of gold and silver commemorative medallions, and it worked on only 2 jobs in April. Job A, a special minting of 1,000 gold medallions commemorating the invention of motion pictures, was started during March and completed in April. As of March 31, Job A had been assigned $30,000 in manufacturing costs, which corresponds with Ruger's work-in-process balance on April 1 of $30,000. Job B, an order for 10,000 silver medallions commemorating the fall of the Berlin Wall, was started in April and was incomplete at the end of the month. When raw materials are purchased, they are added to the raw materials account. The cost of direct material requisitions is added to work in process and the job cost sheet. Indirect materials requisitions are added to manufacturing overhead. All raw materials that enter into the production process are removed from the raw materials account. The journal entry to record the purchase of raw materials on account debits raw materials and credits accounts payable. When materials are requisitioned from raw materials inventory, debit work in process for the cost of direct materials and manufacturing overhead for the cost of indirect materials. Raw materials is credited for the total of the direct and indirect materials. Direct labor is added to work in process and the job cost sheet. Indirect labor is added to manufacturing overhead. All factory labor costs are credited to salaries and wages payable. The $60,000 cost of direct labor is debited to the work-in-process account, while the $15,000 of indirect labor is debited to the manufacturing overhead account. Both direct and indirect labor is credited to the salaries and wages payable account. Additional manufacturing overhead costs are debited to the manufacturing overhead account. The debit side of the manufacturing overhead account represents actual overhead incurred during the period. This journal entry represents the incurrence of actual overhead costs, including utilities used in the manufacturing facility, rent on factory equipment, and other miscellaneous factory overhead costs. It debits manufacturing overhead and credits accounts payable. Other accounts, such as cash, may also be credited. Manufacturing overhead applied is recorded with a debit to work in process and the job cost sheet, and a credit to manufacturing overhead. The manufacturing overhead account is a clearing account. If actual and applied manufacturing overhead are not equal, a year-end adjustment is required. The journal entry to record the application of overhead to work-in-process inventory debits work-in-process and credits manufacturing overhead for the amount of applied overhead. Predetermined overhead rate of $6 per machine hour times 5,000 actual machine hours worked. Non-manufacturing costs are not assigned to individual jobs. They are expensed in the period incurred. Examples include salary expense of employees who work in marketing, selling, or administrative capacity, and advertising expenses. The journal entry for selling and administrative salaries debits salaries expense and credits salaries and wages payable. Office depreciation is recorded with a debit to depreciation expense and a credit to accumulated depreciation. Advertising and other selling and administrative expenses are recorded with debits to the expense accounts and credits to accounts payable or other accounts such as cash. As jobs are completed, the costs are transferred from the work-in-process inventory to finished goods inventory. The sum of all amounts transferred from work-in-process to finished goods represents the cost of goods manufactured for the period. During the month, Job A was completed. This is recorded with a debit to finished goods and a credit to work in process. Because Job B was not completed by the end of the month, its assigned costs will remain in work in process and carry over to the next month. If a balance sheet were prepared at the end of April, the cost accumulated thus far on Job B, $72,000, would appear in the asset account work in process. When a finished job is sold to the customer, the cost of that job is transferred from finished goods inventory to cost of goods sold. Ruger Corporation shipped 750 of the 1,000 gold medallions in Job A to customers by the end of the month for total sales revenue of $225,000. Because 1,000 units were produced and the total cost of the job from the job sheet was $158,000, the unit product cost was $158. 2 entries are required to record the transaction. In the first entry, accounts receivable is debited and sales is credited for the selling price of $225,000. The second entry debits cost of goods sold and credits finished goods for the cost of units sold of $118,500. Learning Objective 3 is to prepare schedules of cost of goods manufactured and cost of goods sold and an income statement. The schedules of cost of goods manufactured and cost of goods sold contains 3 types of costs: direct materials, direct labor, and manufacturing overhead. The schedules calculate 1. The cost of raw material and direct labor used in production and the amount of and manufacturing overhead applied to production. 2. The manufacturing costs associated with goods that were finished during the period. Raw materials purchases made during the period are added to beginning raw materials inventory. The ending raw materials inventory is deducted to arrive at the raw materials used in production. As items are removed from the raw materials inventory and placed into the production process, they are called direct materials. Raw materials available for use in production minus ending raw materials inventory equals raw materials used in production. Direct materials used flow into work in process. Direct labor used in production and manufacturing overhead applied to production are added to direct materials to arrive at total manufacturing costs. Direct materials plus direct labor plus manufacturing overhead applied equals total manufacturing costs. Total manufacturing costs flow into work-in-process inventory. Total manufacturing costs are added to the beginning work-in-process to arrive at total work-in-process. Manufacturing costs consists of direct materials plus direct labor plus manufacturing overhead applied. These costs flow into the work-in-process account and are combined with the beginning work-in-process inventory to equal the total work-in-process for the period. Raw materials available for use in production equal beginning raw materials inventory plus raw materials purchased. Cost of goods manufactured equals total work-in-process for the period minus ending work-in-process inventory. The ending work-in-process inventory is deducted from the total work-in-process for the period to arrive at the cost of goods manufactured. The cost of goods manufactured is added to the beginning finished goods inventory to arrive at cost of goods available for sale. The ending finished goods inventory is deducted from this figure to arrive at cost of goods sold. Beginning raw materials inventory was $32,000. During the month, $276,000 of raw material was purchased. A count at the end of the month revealed that $28,000 of raw material was still present. What is the cost of direct material used? The correct answer is $280,000, calculated as shown. The correct answer is $835,000, calculated as shown. Beginning work-in-process was $125,000. Manufacturing costs incurred for the month were $835,000. There were $200,000 of partially finished goods remaining in work-in-process inventory at the end of the month. What was the cost of goods manufactured during the month? The correct answer is $760,000, calculated as shown. Beginning finished goods inventory was $130,000. The cost of goods manufactured for the month was $760,000, and the ending finished goods inventory was $150,000. What was the cost of goods sold for the month? The correct answer is $740,000, calculated as shown. Learning Objective 4 is to compute underapplied or overapplied overhead cost and prepare the journal entry to close the balance in manufacturing overhead to the appropriate accounts. The difference between the overhead cost applied to work in process and the actual overhead costs of a period is referred to as either underapplied or overapplied overhead. Underapplied overhead exists when the amount of overhead applied to jobs during the period using the predetermined overhead rate is less than the total amount of overhead actually incurred during the period. Overapplied overhead exists when the amount of overhead applied to jobs during the period using the predetermined overhead rate is greater than the total amount of overhead actually incurred during the period. Perco's actual overhead for the year was $650,000, with a total of 170,000 direct labor hours worked on jobs. Perco's predetermined overhead rate is $4 per direct labor hour. Overhead applied during the period is equal to $4 per direct labor hour times the 170,000 direct labor hours actually worked, for a total of $680,000. Perco's actual overhead for the year was $650,000 and applied overhead was $680,000, so the company has overapplied overhead for the year of $30,000. What will Perco do? Tiger Incorporated had actual manufacturing overhead costs of $1,210,000 and a predetermined overhead rate of $4 per machine hour. Tiger Incorporated worked 290,000 machine hours during the period. How much is Tiger's overapplied or underapplied overhead? The correct answer is $50,000 underapplied overhead. Tiger incurred $1,210,000 of actual overhead, but only applied $1,160,000 of overhead. Any remaining balance in the manufacturing overhead account, such as Perco's $30,000 of overapplied overhead, is disposed of in one of two ways. 1. It can be closed to cost of goods sold. 2. It can be closed proportionally to work in process, finished goods, and cost of goods sold. The journal entry in T account form to close out Perco's $30,000 of overapplied overhead into cost of goods sold is to debit the manufacturing overhead account for $30,000 and credit or reduce cost of goods sold by the same amount. To calculate the allocation of underapplied or overapplied overhead between work in process, finished goods, and cost of goods sold, the overhead applied currently in each account is needed. Let's assume the overhead applied in ending work in process inventory, ending finished goods inventory, and cost of goods sold is $68,000, $204,000, and $408,000 respectively. Total value of accounts $680,000. In this case, the allocation percentages are 10% for ending work in process inventory, 30% for ending finished goods inventory, and 60% for cost of goods sold. Work in process is allocated 10%, or $3,000, finished goods is allocated 30%, or $9,000, and cost of goods sold is allocated 60% of $18,000 of the overapplied overhead. The journal entry to record the allocation is to debit manufacturing overhead for $30,000, credit work in process inventory for $3,000, credit finished goods inventory for $9,000, and credit cost of goods sold for $18,000. In summary, there are two methods for disposing of underapplied and overapplied overhead. 1. Close out to cost of goods sold. 2. Allocate between work in process, finished goods, and cost of goods sold. The allocation method is considered more accurate, but is more complex to compute. Will overapplied overhead increase, decrease, or have no effect on net operating income? Net income will increase. Remember that overapplied overhead increases net operating income and underapplied overhead decreases net operating income. End of Chapter 3.